Assalamu alaikum and welcome to the Oasis Focus on Finance show. I am your host, Shafiek Morton. As always, it's great to be with you. In this week's show, we're going to be having a look at property as an asset class. We're also going to have a look at how an investor can be exposed to the property market and, of course, what is the outlook for the property market. Later on, we'll discuss Oasis's philosophy with regards to investing in property, and then we'll have a look at some of the products that are available to you, the client or the potential investor. In studio with me today are Isma-el, Ebrahim and Fahad, Shaikh. Gentlemen, assalamu alaikum.
Wa alaikum salam, Shafiek.
Isma-el, let's start off with you. What avenues are available to somebody who wants to invest in property right now?
Generally, I think there are three ways in which you can get involved or invest in property. You can either do it directly, you can do it through the listed environment, or you can do it through institutional products, which places like ourselves offer. On the direct side, as a direct investor, we all know that you can either invest in a flat or a property, an apartment or a house or whatever the case may be. That, while in the one term has served as a long history, there is a long history of people doing that since time immemorial, it does become quite capital intensive. So you need access to the debt markets if you don't have the cash available, which very few of us have. So it is quite capital intensive. It's a big upfront investment. Also, it's quite maintenance intensive. So you need the skills and you need to manage contractors, or if you're doing repairs and maintenance and that type of thing, and that becomes intensive. So from that point of view, and also then depending on the type of property you invest in, the area, the location, that brings with it its own risks. In the listed space, once again, you do need certain skills. So you need to be able to research what are the best listed companies. You need to understand the markets. You need to understand the liquidity of the investment. You need to understand the underlying locations and attractions or barriers to entry of those individual properties. So it becomes quite, let's call it energy intensive and labor intensive, as well as it could also be expensive. So you've got securities tax and trading tax, and you've got broker costs and that type of thing which you might have to pay. And then also you've got the institutional space, which is actually quite tax efficient. So in that space, how that works is you pay a fund manager to place your money, and they would place it in various property related products. So they're doing the research, they understand property, and they're placing it with people with property management skills, which you might not necessarily have. Also, you're getting the same benefits of a regulated environment, highly regulated financial services board, JSE listing requirements, that type of thing. So you've got very strong professional management, highly regulated environment, and you also have lower costs because you're putting it with institutions which do those, let's call it labor intensive scenarios for you. So I think those are the three ways, and they've each got their own benefits and disadvantages.
Fahad, then to follow on with what Isma-el has said, what then would make your institutionalized property more of an attractive benefit than the direct thing which Isma-el mentioned when he started off?
If you just look at property as an asset class relative to some of the other asset classes which are available to investors, what you'll notice is that over time, property without debt has shown very low correlation relative to other asset classes, which makes it very instrumental in terms of diversification within an investment portfolio. Then if you compare institutional property relative to, let's say, direct, I think one of the biggest advantages, as Isma-el highlighted, if you want to go the direct property route, you need a large capital investment upfront. Whether it's the down payment that you're putting down, and if you want to get a mortgage, you need bank funding which comes into play. And even then, you're not getting a diversified exposure because you're maybe buying one property, two property, or maybe three, whatever the number is. It's not a very diversified exposure, which exposes you to risks within certain areas or many property-specific risks. Relative to that, if you're investing in an institutional product, whether it's a unit trust or an endowment, firstly, you're getting access to a very, you have the ability to get access to very high quality and a much larger range of properties. So for example, if you're investing in a unit trust with a very small nominal amount of money, your money is actually spread across geographies, across the retail sector, the industrial sector, the office sector. So you get those diversification benefits. Secondly, as Isma-el again highlighted, with direct property, if you're renting it out, You actually need the costs, the admin processes in terms of collecting those rents. And, and also the cost in terms of screening the tenants that you might be putting into those properties. So again, when you're investing in institutional property, those companies are being managed by professional property experts, who are doing all of that work on your behalf. So it's a lot less admin intensive, lot less cost intensive. And secondly, depending on the product you're going into, it can also be very tax efficient in terms of when you're investing in institutional property. So you get these benefits, and at the same time, it's not detracting from your initial aim of why do you want to invest in a property. You want consistent income in terms of rental through long-term leases. You want capital appreciation, and at the end of the day, you want to hedge your money against inflation. So you're getting those benefits in institutional property while also getting the additional benefits of diversification, getting access to high-quality properties.
Isma-el, I think the million-dollar question, literally, what is the general outlook for the property market right now?
Look at the two spheres. You've got the global space and then you've got South Africa. Each of them have their own dynamics, while the global environment does play a role or does impact the South African environment or industry as well. On the global front, I think the uncertain political environment is creating opportunities. So whether it's the Trump situation in the US or whatever the case may be, Brexit, whatever that case may be, it is providing opportunities because some counters are coming lower, moving lower, and we continue to monitor those. In terms of the global space, from a theme point of view, there are certain themes that we like to play and that we see panning out. But just overall, from a yield perspective, we see that in terms of, if you look at the dividend yields and the property counters are providing globally relative to bond yields, that spread has widened because dividend yields have held up quite nicely, cash flows are good, and bond yields are extremely low. So the property counters globally are still quite attractive, other than Japan, where that spread is not as wide as what we see globally. Also, if you look at the counters globally, their debt levels, especially in the US and Europe, those debt levels have moved a lot lower from their peaks in 2008. So those countries have reduced their debt levels. They now have access to lower cost debt, and they've extended their debt maturity. So that's also reduced risks somewhat. And then when I touched on themes, what we see globally is there continues to be access to funding for speculative development in Europe and the US continues to be limited. We continue to see net positive absorption. Now, what does that mean is your demand is outstripping supply, so your underlying property fundamentals continue to be positive, and we continue to see themes playing out which we believe will be positive for these counters. And for example, we see high quality super regional shopping centers that are close to major global cities. Those counters that are placed to benefit from the aging population of the developed markets. So, for example, your retirement home providers or seniors housing providers. And then also those counters who benefit from the digital age, which can be online retail and then also data demand, data centers, that type of thing. So those will continue to benefit. And then in South Africa, it's a bit different. Many of the risks we have taken into account in our investment process, and we positioned our funds accordingly. And that may be, so what we're seeing in South Africa is the other spectrum. Your bond yields are quite high, and your dividend yields have moved lower because the prices of those property counters have moved up. At the same time, there is risk in terms of the timing of offshore investments which our local property players have taken into Eastern Europe or wherever the case may be. They've taken money offshore with the rand at 17 rand to the dollar, for example. So those risks we have priced in. If we look at the individual sectors on the retail side, we continue to see super regional malls should continue to attract demand, and their trading should continue to do well. And then as well as local convenience, what we call urban periphery shopping, those malls that are basically convenience offerings will continue to do well. Medium-sized malls we are seeing come under pressure. Their rent-to-sales ratios have moved up, indicating some risk. On the office side, that's linked to business confidence and the economic growth, which we think will continue to take time to recover. And then also new supply in the very high-end A quality or platinum grade has come online, placing pressure on your B and C grade offices. On the industrial space, we think that the continued move towards online retail and high quality logistics will continue, and warehousing that will continue to drive demand for high-end warehousing. However, your light manufacturing, that type of thing will continue to be under pressure. So there are pockets of opportunity in the South African market, but we have also taken into account the risks and positioned our funds accordingly.
Fahad, let's get back to you. How do we understand property as an asset class, but within your broader investment strategy?
Shafiek, when anyone's looking to build an investment or a savings portfolio, you need to ensure that you've got a very good mix between growth assets, which is things like, for example, equities, and your income generating assets, which might be your investments in Murabahas or Sukuks, for example. So you need a good mix between the two, and that mix is dependent on what your individual characteristics are in terms of how much risk you're able to take and how much risk you should be taking. So if you look at it, if you look at property, it fits very nicely between that equity, between that growth and income asset classification. Because firstly, if you're buying into a property, you get the benefits of regular rentals coming through, which is more of an income generating asset perspective. But at the same time, you get rental growing every year, and at the same time, your property gets capital appreciation. So property provides you a good mix of both income and capital growth. And at the same time, if you look at some of the products that Oasis offers, so if you look at the Oasis Crescent Stable Fund of Funds or Oasis Crescent Progressive or High Balanced Equity Balanced Fund, what you'll see is in all those funds, there's a property allocation of between 10 and 16%. So depending on what your risk profile is and depending on which fund you goes into, property can be part of each of those portfolios, whether you want higher risk, medium risk or lower risk. So property it should be an integral part of all those asset allocations.
What is your selection criteria when you are looking at what we've just discussed in terms of property? Obviously, you get different kinds of property, as we've said.
Shafiek, I think the most important thing is, I think Isma-el spoke about it a bit earlier, the supply-demand fundamentals are very important. And then we also look at some very secular growth stories. For example, if you look at the retail evolution globally, what we're seeing is all your large retailers, they're focusing more on their flagship stores rather than on their B and C grade stores. The reason behind that is that because of online coming into play, a lot more sales globally moving onto the internet, fewer people are going to some of the B or C grade stores. So either you're in a very convenient location, or you're a landlord which houses the flagship stores for all your big brands like the Zara or the Gaps of the world or the H&Ms of the world, for example. So we're making sure that our investments are focused on those themes. Secondly, when we talk about e-commerce, as a lot of these retailers are trying to cope with internet traffic or internet sales, you need a lot more logistics capabilities, high-end logistics capabilities, to be able to make sure you're able to serve your customer within 24 hours or overnight or within 2 or 3 days, whatever the time period may be. So there's growing demand for that high-quality logistics, and we make sure we bring that into our investment thesis. Secondly, Isma-el briefly touched on data storage. So again, with internet growing, video streaming, all of these things growing, your demand for data storage is increasing exponentially, which in turn increases demand for your data centers. And again, that's a theme that you can play if you're investing in property. And then also something like aging populations. In the developed world, a large proportion of your population, going past retirement age. And obviously there's seniors, assistance living, or those sort of areas which you can get exposure to. So these are some of the secular themes. And then other than that, I think the centuries-old adage location is very important. So across the different, whether it's retail, whether it's industrial, whether it's office space, we need to make sure that we're only investing in the highest quality locations. And then you need to make sure the assets that you're buying, they've got high quality tenants in there, you've got long-term leases, to make sure the tenants are of the quality that they continue to pay you on time every year. Secondly, those leases need to be long-term in nature, because you don't want to go through the process of re-tenanting, refixing those properties on an annual basis, which also obviously introduces risk as well in terms of whether you will be able to let those businesses out. So you need those long-term lease expiry profiles. And then without going into a lot of detail, you need strong balance sheets. Because if property only differentiates itself from other asset classes, or the correlation is lower if there's not a lot of debt involved in it. So you don't want to expose yourself to property investments where there's a lot of debt involved. We saw what happened in 2008, 2009 with those sort of investments. And at the end of the day, we want to make sure that we're buying these high quality assets at a cheap discount to what their intrinsic or fair value is. And I think it's these sort of factors which make sure, bringing these into our investment analysis, that make sure we deliver the downside protection and the real wealth creation for our clients.
Isma-el, recently Oasis launched the Oasis Crescent Property Endowment Fund. Tell us something about this new product.
I think the objective of the fund and the reason for the launch was to provide a Sharia-compliant property-related product that can provide stable capital growth. Fahad talked about it, income growth, as well as capital appreciation over the long term in a Sharia-compliant manner. So that's a product that we've now brought to the market. If we look at the underlying investments or the opportunities there are, it's either through your direct property investments, which we obviously invest in direct properties, your local listed investments, and then also your global listed investments, property-related investments. On the direct side, it will provide investors. Now, we talked earlier, property is generally capital intensive, so it's a big capital investment upfront, ties up your capital. Now, through a vehicle like this, you don't necessarily have to put 3 million rand down as an individual. You can take smaller increments and still get exposure to properties which you would not necessarily have exposure to. A big retail center, a fantastic warehouse, or whatever the case may be. So on the direct side, it gives you an opportunity to participate in fantastic locations, good quality tenants, locations that you would not necessarily otherwise have had access to, and very good cities which continue to have good demand drivers. Also, what we like to do is we like to do things with as little debt as possible. So having very little debt provides you the flexibility to take advantage of any opportunities that may come up. And then also a very important aspect with property is that when you have, we talked about correlation to equities, and what that means is, so how does the property market react, or how does it react compared to the way equities react? And when you have a debt-laden property instrument, it reacts very similar to equity. But when you have very little debt, you dislocate that behavior relative to equity. So we continue to look at that, having as little debt as possible. And then also it gives you access to good, high-quality tenants and long-term leases. So as an individual, you might not have access to a fantastic global multinational retailer. But through us, you can get that access to a building that has a national tenant in, or an international tenant. Then you've got your local listed investments. We've got a 10-year track record in that space. And some of the things that we invest in, for example, is the Oasis Crescent Property Fund. It's generated returns of 13.9% since inception, November 2005. And if you compare that to inflation of about 7%, 13.9%, it's been a fantastic return. It's protected your capital fantastically, as well as provided income growth. And that is something that we're very proud of. On the global space, we've also have a long-term track record. And through that continues. We talked about the secular demand drivers. So through us, you can get that access to those demand drivers, which we talked about, those property fundamentals in the global space, which you would not have access to, the net positive absorption we talked about earlier, and then also access to those themes we talked about, the aging population, the digital age and data demand, etc. I'll give you an example of some of the counters that we invest in globally. It would be, we invest from South Africa, we invest in the largest seniors assisted living property provider, the largest data center provider in the world, the largest shopping center owner in Europe, or high quality shopping center owner in the US and Europe. And we give you that opportunity to access that through our global funds. So that in a nutshell would be the opportunity that the Oasis Crescent Property Endowment Fund offers.
Now you've given us all the exciting components. Why should myself as an investor actually invest in the Oasis Crescent Property Endowment Fund?
I think an endowment provides a very good disciplined way of saving for an investment goal. So you set that goal and you save over a certain period of time, over a fixed period of time. Also from an endowment perspective, it's tax efficient. So the endowment company itself is taxed at 30%. So if you are in that high income tax bracket that's being taxed at 40% plus, it makes a lot more sense to save through an endowment. You get taxed once off in the endowment company, and then any returns that come subsequently through to you as the investor is not taxed, because it's already been taxed at the endowment company level. Also, we indicated earlier, you have access to very good property locations which you would not necessarily have had access to as an individual investor. You can access that through smaller increments rather than a big capital investment up front. Properties in strong locations have high barriers to entry, so you can't replace a location. The waterfront, for example, is a location that can't be replaced. It can't be replicated. They've tried to replicate it in the north of the country, etc. It can't be replicated. So your location will continue to, locations are advantages that you have as a title deed holder that you have, and that through the Oasis Crescent Property Endowment Fund you get access to that. Also a very important thing is, I mentioned it earlier, you get access to a vehicle that is regulated. Many of these property vehicles that we've seen come up recently, especially in South Africa, people have burnt their fingers because it hasn't been regulated to the extent that we are regulated. You're getting access to property management skills. We've got a 10-year track record. It's there for everyone to see, both in the listed space as well as in our investment space as a fund manager. So you're getting access to property management skills, direct property management skills. You're getting access to locations, and also you're getting access to tenants that you would not necessarily have had access to with long-term leases. So I think those are the opportunities that the Oasis Crescent Property Endowment Fund provides you. And then also you're paying a fund manager like ourselves with the expertise, and that will reduce your costs. So it's less costly. We do the work, and you get the benefit. That's what we're there for, to add value to our clients.
Isma-el and Fahad, thanks for chatting to us about property.
Thank you, Shafiek.
And that concludes today's edition of the Oasis Focus on Finance show, during which we discussed property. Special thanks to our guests Fahad Shaikh and Isma-el Ebrahim. Should you wish to watch this or any of our other shows, you can log into the Oasis Crescent YouTube channel. Should you wish to contact Oasis, you can dial 0860 100 786 or email info@oasiscrescent.com. Until next time, I'm your host, Shafiek Morton. Assalamu alaikum wa rahmatullah.